What's up, everybody? It's Jackson. We're back. This is GNS Academy, and this is another video on the A to Z educational series that should be able to teach you how I trade, how we trade here at GNS Academy. This video is going to be about ICT concepts. Okay, ICT concepts include fair value gaps, liquidities, um, inversions, order, all those stuff, right? But there are more to ICT. There is more to ICT that makes your analysis stronger, but they're not mandatory. Okay, things like the market maker model, SMT, Power of Three, and macros. There are many videos online that focus on each of these concepts individually, but I figured I'm gonna try making just these extra little concepts in one video. It shouldn't require a bunch of videos, okay? If you have not watched the other videos, watch them. Okay, the first video is going to talk about the history of trading, how we are even trading now, the evolution of it. What is futures trading? It's important to know if you want to be a trader. You can't just hop on and start making money, and then someone asks you what is trading, you don't know. Okay, watch that video. Second video is about dojis and candlesticks and engulfings. Know that stuff. That's how we start reading the candlesticks and reading and understanding the language. Then we have fair value gaps. Then we have liquidity. So we're moving on. We're getting closer. This is going to be just a finishing touch of the concepts that we use. And then the next video should be pretty much going over our entry models. Okay. Um, just to let you know a little bit about me, I've been trading for 4 years. I've been profitable for a year and a half. I got multiple funded accounts. I just requested another payout. It just hit today. All glory to God. Okay. Um, I have a student. He's funded as well. He just got a payout today as well. So if I can do it, if he can do it, you can do it. The only reason why I'm teaching people is because I was able to replicate it. Okay. There was a time where I was not confident in teaching people. Is one thing to know how to trade, is another thing to teach someone how to trade, and that's another thing how to teach people how to trade. So, you know, if you're already here, good job. Give yourself a pat on the back. Get your pen and paper out. Let's get to it. So, the agenda today, we're going to be going over the market maker model, SMT, Power of Three or AMD, and macros. Okay. So let's look at this real quick. Okay. Market maker model. Okay, a market maker model. That's what MMXM stands for. When you see someone on Instagram, YouTube, TikTok, MMXM, that means it's a market maker model. Okay, a market maker model is just a zoomed out view of price action, of price structure, and it tells you where it might want to go. Um, if we're on a downtrend and we tap a key level, we want to look for it to reverse and make an uptrend. Okay, now if we're on an uptrend and we tap a key level, we want it to reverse and make a downtrend. A market maker model is just uptrend and downtrend. It's super simple, super easy. It's just called the market maker model. ICT, you know how analytical and technical it could be. So let's think of a market maker buy model, MMBM. Okay. MMXM is just market maker model. The X is the variable. Like it could be a market maker buy model, market maker sell model. Market maker model is MMXM. Market maker buy model is MMBM. Okay. A market maker buy model will happen when candles are in a downtrend, taps a key level like a 4-hour fair value gap, 15-minute fair value gap, hits liquidity, and then it starts popping up. Okay. That's the market maker buy model. When it starts creating the uptrend, the buy, then that's called the buy side of the curve. We're starting to make a curve up and go buy. Okay, the buy side of the curve, the uptrend, the market maker buy model. Okay, those three words correlate with each other. Market maker sell model. Okay, MMSM. A market maker sell model is going to happen when candles are in an uptrend, hits a key level, fair value gap, takes liquidity, um, hits that key level, and then once we hit it, we it starts coming down and makes a downtrend. So it's literally just a curve, like a bell curve, going up and down. Going up is an uptrend. It hits the fair value gap, 4-hour fair value gap, higher time frame key level, and starts going down, making a downtrend. When it starts going down, now we're doing a market maker sell model. Start looking for sells, because we're going on a downtrend. Pretty much what I'm saying is a market maker buy model is when we go on a downtrend, hit a level, and go on an uptrend. Market maker sell model is when we're on an uptrend, hit a key level, and go on a downtrend. They're called different things though. They're just more vocabulary, more kind of in depth, instead of saying, oh, it hit an uptrend and then came to a downtrend. Oh no, it's a market maker sell model. Okay. We'll give some examples here. Boom. What is this right here? A market maker buy model. Why? Because we're starting to go in the uptrend. We're starting to go for the buy side, and look at the curve. It's starting to go up like a buy side of the curve. Okay. Market maker buy model is because at the end of the day, it starts buying up. It comes down, hits the higher time frame key level, and then it starts going up. The buy model, okay? But what is it doing here when it's coming down? It's setting liquidity here, liquidity here, liquidity here. So the buy model is going to start attacking liquidity, attacking liquidity, attacking liquidity. That's why we want to be entering here, entering here, entering here on the buy model. Just know that you're in an uptrend, or you could say, oh man, I took the buys. There was a market maker buy model. I was taking buys, okay? Same thing here on the opposite end. Market maker sell model. Okay. We hit a higher time frame PD array. We hit the higher time frame 4-hour fair value gap, 1 hour fair value gap, daily fair value gap. We're on an uptrend, going up, leaving liquidity, leaving liquidity. What does it do? Come down and start making the sell model, market maker sell model, or the downtrend. Okay. Okay. So next, here's some examples. Okay. Um, Real life examples. What do we have here? A downtrend coming into a blue zone, which is my 4-hour fair value gap, and then if I can, excuse me, then it starts going up. Okay, um, taking liquidity, taking liquidity, taking liquidity, taking liquidity. But what is happening here? Downtrend hits a key level, uptrend. Okay, same thing here. Downtrend hits a key level, uptrend. Downtrend hits a key level, uptrend. Buy side of the curve. We're going up. Okay. This is a market maker buy model. If I just showed you a picture, boom, what is this? Market maker buy model. Okay. Opposite here. Uptrend, 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 hits a blue zone, hits a key level, takes liquidity, and then boom, starts coming down. Market maker sell model. We're in a sell model. Look for more sells down here. Look for more sells. Keep on going. Go on the sell model. Uptrend, hits a level, downtrend. Market maker sell model. So you would talk and say, oh my gosh, I went for sales. It was a market maker sell model. It was perfect. Okay. That's the terms that you're going to hear us say in this Discord. Okay. Next, we're going over SMT. SMT stands for smart money techniques. Okay. But the strategy is called SMT divergence. Okay. SMT is a concept that tries to identify the reversals or let you know if this is a good time the price is going to turn around based off of two pairs. Okay, what we use is Nasdaq and the S&P 500. Nas and S&P 500, they move the same. They're extremely correlated. But if one does something and the other's not doing, it should give you a hint that the other one's going to end up doing it too. I'll explain what I mean here. Um, so when taking a trade on S&P 500, look at the Nasdaq. Okay, was sell side liquidity taken, or was liquidity taken at all? Was liquidity taken on Nasdaq but not S&P 500? That's the divergence. Okay, you could pause here and read a little bit more here if you want. But why is it important? Essentially, it's a clue that the algorithm has taken liquidity on one asset, but not the other. Since it took on liquidity from one asset, it might be ready to reverse. Let's say we're just looking at NASDAQ. It takes liquidity and we go for buys. Okay, we saw that it took liquidity. Obviously, we want to look for buys. But let's say we're on S&P 500 and it doesn't take liquidity. We might be thinking like, oh man, like it wants to take liquidity. Maybe I shouldn't go for buys. But then you look at NASDAQ, it did take liquidity. That should be a hint that the algorithm has taken liquidity on one side and is ready to go because they're correlated, they move in pairs. Okay. Here's a example on the line chart. Let's say this is NASDAQ and this is S&P 500. What happens? Liquidity is taken, right? Boom, sweep of liquidity and it goes up. Okay, that's normal. That's what we like to see. But look on the S&P 500. It didn't take liquidity. This is SMT divergence. There's a difference. Okay. That's a good sign that buys would work in this case. Now let's look at this side. Let's say this is NASDAQ and this is the S&P 500. Okay. Wait, did I? Okay. Let's say this is NASDAQ and this is S&P 500. Okay. NASDAQ, what does it do? It takes the high, sweeps liquidity and starts going down. But this one, it doesn't take a liquidity, still goes down because there's SMT divergence. It only works on correlated pairs. There's no SMT divergence between like NASDAQ and the NZD USD or something, you know, like NZD CHF. Like there has to be correlating assets. When you look at S&P and Nasdaq, they move exactly the same. So when there's a divergence, that's a good clear sign that something's happening and that we should pay attention, and our trade might have a better chance of working. This is Nasdaq. This is S&P 500. This is at the same exact time. Okay, what happens here? We take sell side liquidity over here, whatever. But look what happens here. SMT. Look at what happens here. This line from here to there, there's no liquidity taken. But look at this one. The line from here to here, liquidity is taken. And look what happens. It flies up. It flies up. This is a great indicator that we should go for buys. That's why I took it. We took sell side liquidity. We took sell side liquidity. We're in a 4-hour fair value gap. Buy side of the curve. We're coming down and we go into buy side of the curve. And then we wick down and then we do an inversion and I'm entering for buys. Okay. But what really gave me confidence was SMT, because I looked on ES on S&P 500 and it did take liquidity down here, but it didn't take it on mine. That's SMT divergence. Same thing on the opposite end. Okay, this is Nasdaq. This is the S&P 500. It's going up. It goes into my key level, my higher time frame, 4-hour fair value gap, and it starts coming down. I enter sells. What do? We took liquidity at this high, but look at ES. Look at the difference on the S&P 500 on ES. It not even nowhere near that high. ES is already fallen down. It's already on the way down. And NASDAQ took liquidity and this one didn't. Like, this is a huge divergence and a hint, a clue that that we're gonna keep on going down because they're correlated. So since that one's going down already, like we should be following suit. We took one took liquidity on one, but the other one didn't. And then we're starting going the other way. Like that should be a clue. Even if mine didn't take liquidity, but the other one did, that should be a clue. Okay, that we should be going down. That's SMT divergence. Next, power of three. Why is it called power of three? Because it is 3 words. Okay, the power of three, the power of the 3 words: accumulation, manipulation, distribution. Okay, they also call it AMD. So you'll hear them interchanging. Oh, there's some AMD here. This is good. There was power of 3 here. This is really good. People will just say straight up accumulation, manipulation, distribution. Okay. These are the correlated words with accumulation, manipulation, and distribution. When we say accumulation, we mean consolidation. Okay. Price is zigzagging, comes up, and then comes down. Okay. Or not, sorry. Price is zigzagging. That's consolidation. Price is zigzagging, right? Watch the first video or the second video, I think, or the first video where I talk about how the market moves. The market moves in 3 ways: an uptrend, a downtrend, and consolidation. Okay. Consolidation is the same exact word as accumulation. It's consolidated. It's accumulated. It's accumulating orders. It's chilling out. Price is chilling. Okay. That's accumulation. Okay. Manipulation is the same thing as a liquidity grab. Okay. When I'm in a trade and I'm going for buys and then the candle comes down and boom, takes me out, I got a liquidity grab on me. The market manipulated on me. Manipulation. Okay. So we have accumulation where it hangs out, consolidates, zigzags. Manipulation where it does a wick, a liquidity grab up or down. And then the third part will be distribution. Okay. Where then it starts the uptrend or the downtrend. Distribution is uptrend or downtrend. It doesn't matter which way. But it goes in that specific order: accumulation, manipulation, distribution. It's not distribution, manipulation, accumulation. No, it's first consolidation or accumulation. Then we get a liquidity grab and then we distribute. Okay. Do I have an example? Yes, I do. Okay. So look what we have here above. What do we have here? Okay. We have, oops. What do we have here? We have accumulation. Okay. Zigzag price. Look how small these little candles are. Accumulation, accumulation, accumulation. What do we have here? Boom, a complete huge drop. Okay. What is it taking? Sell side liquidity, sell side liquidity, sell side liquidity. Okay. Accumulation, manipulation, taking out liquidity. And then what do we have right after that? Distribution. Boom, uptrend, uptrend, uptrend. Get in where you fit in. Okay. Take the buys here. We go for buys. Get in where you fit in. Accumulation, manipulation, distribution. Okay. Accumulation, manipulation, distribution. Okay. It's a natural phenomenon that works all the time. That's how candles are built. This is what it looks like too on a line chart, right? Accumulation, zigzag, manipulation, comes, takes liquidity, distribution. But this right here is also making a candle. This is a 1-minute time frame. But how many 1-minute candles are in a 4-hour candle? like 240, right? 60 minutes, 61-minute candles, 4 hours, 240 candles, right? So let's say this is a 4-hour candle. What's happening if we zoom in on this 4-hour candle? We're having the 1 minute time frame accumulating on the bottom, manipulating, making this wick, distribution, boom. We want to be anywhere around here, the distribution, the manipulation area, okay? We do not want to be in the consolidation, accumulation. This is AMD though, accumulation, A, manipulation, M, distribution, D. There are hundreds of examples of this, okay? If I can really quick, let's see. What do we have here? Accumulation, right? This should be accumulation, right? Accumulation or consolidation. Oh, I got dark as hell. Or consolidation, okay? Now, what are people doing in the market? They have a freaking order here to go for buys if it breaks out of this range, right? They call it range breakout, okay? And if it goes down here, then they're going for sells. Okay. So whichever happens, happens. Let's say I'm chilling here and it's accumulating and then it pops up. Oh man, okay, I'm gonna go for buys. Or if it pops down, okay, I'm gonna go for sells. What is the market always trying to do though? Manipulate people. It's trying to get people out and make them lose so that there's more money for people to get paid. If everyone won, then it wouldn't work. So watch that video of liquidity and the theory of liquidity. Okay. It's not a theory, but look at it. So what is this? Accumulation. Okay. Then what's the next part of AMD? Manipulation comes up. Then what's the last part? Distribution. Okay. Accumulation, manipulation, distribution. Happens all of the time. Okay. Now, vice versa. What is this? Whoops. What is this? Accumulation. What's the next step? Manipulation. And then what is this? Distribution. Accumulation, manipulation, distribution. AMD. Okay. Also known as power of three because it's 1, 2, 3. Okay. Accumulation, manipulation, distribution. Okay. Now let me show you just a couple more examples because that's just a drawing. Let's go on the Discord. Look what we have here. What is this? Accumulation. What is this? Boom, manipulation. People are going for buys. Oh yeah, let's go for buys. Boom, distribution. Look how far it went down. What did I enter? Right here, right here. We could eat off of that right there. Accumulation, manipulation, distribution. What's going on over here? Accumulation. What's going on here? Accumulation. Accumulation. There's liquidity right here. There's liquidity all right here. What happens next? Manipulation. Boom. Takes out liquidity. Takes out liquidity. What happens next? Distribution. Where can you get in? OTE entry. You have an inversion on the 1 minute somewhere here. There's an order block, breaker block. Like, get in where you fit in. There's many ways to eat off of accumulation, manipulation, distribution. Just know where you're at in the market. That's what's important about accumulation, manipulation, and distribution. Know where you are. Okay. Because it'll really help. Let's see if I can find one more like this one. Beautiful. This is before the market open. The market opens for me at 7:30, so we're opening right here. What happens here? Accumulation. Look at all this zigzag accumulation. What happens here? Boom, a manipulation, hard manipulation, taking liquidity, taking liquidity, taking liquidity, and what does it do? Tap into a 15-minute fair value gap, tap into a 4-hour fair value gap. Accumulation, manipulation, AMD, right? And then what do we have next? Distribution. I enter buys right here. Distribution, it wins. But also, what do we have? SMT. What does that mean? If there's SMT on ES, then that means that there's SMT on NASDAQ. If it did not take liquidity on ES, then what happens on NASDAQ? That means it took liquidity. This is like a AAA A+ setup. Accumulation, manipulation, distribution, sell side liquidity taken, 4-hour, 15-minute fair value gap, SMT, EMA breakout, 4-minute inversion fair value gap, order block created, the respected order block the whole way. What more do you need? 4-hour candle wick, literally. This is the wick. We're entering right off the wick. Watch the EMA video if you don't understand what I'm talking about with the EMAs, but this is EMA alignment. It just took forever to win, but that's accumulation, manipulation, and distribution. Okay, um, it's really good, really helpful. Almost it happened here today too, but this is the trade that we took today, accumulation, but it did come down, but then it came back up. So it did manipulate and distribute down, but this was kind of weird because it could throw people off. Oh, Paris, you said accumulation, manipulation, then shouldn't it distribute up? Well, we're leaving a 4 hour and a 15-minute fair value gap. The EMAs are above. You don't just take, you have to like put things into context. It still is technically accumulation, manipulation up here and distribution down, but this is kind of threw it off, which is why I did not include it in my analysis here. Okay. Mm, so market died out over here. I'm looking for sales around here. Um, okay. Last but not least, we have macros. Okay. Now, macro times. Okay. Macro theory is pretty much the theory that the banks, big institutions, hedge funds, investment firms, they can't just when people do a $1 million investment or whatever, they can't just enter the market with $1 million or fly away. So they disperse it in different times. Okay, it's a short order of instructions that creates an event in price delivery. Let me try to repeat that because I don't even know if I understood what I said. A macro is a short order of instructions that creates an event in price delivery. How can I break that down? The algorithm or the banks, which technically are moving the market, right? They are there are events in price delivery that they are using on purpose. They cannot, and you could watch a podcast too, so it's not even necessarily a theory, but um, the markets can't just dump a huge investment into the market. The banks and all these people, the banks, the institutional people, they cannot just dump a huge amount of money into the market. They have to deliver it in different times. And the theory is that during the macros, these macro times, these windows, this is I think I think it's Eastern time. Geez, you might need to double check. But these macros um essentially are the times where you can notice that boom, we go the candles will come up with more volume. Why? Because it's the idea that the banks and the institutions are starting to pump the market with some orders. They can't just deliver it all at once, so they have to deliver it in times and fractals. That is the truth. Now, is it happening at a macro? Check for yourself. Okay, there's different macros: 750 to 810, 850 to 910. What you'll notice is that they're at the end and the beginning of the hours. Okay, the end of 7 o'clock to the beginning of 8 o'clock, the end of 8 o'clock to beginning of 9 o'clock, and the 9 o'clock beginning of 10. Um, I think this is my time in El Paso, which I'm in Mountain Time. So you look up the macros for yourself wherever you're from. Okay. Um, Let me try to look at a couple of examples really quick. Hopefully, it's a quick video. So let's look at some OTE entries. I mean, sorry, OT. Excuse me. Jeez. Let's look at some macro. Which trades have I taken with macro? Mm-mm-mm. Macro, 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 macro. Okay, we had a macro here. Oh, that's the example I was using earlier. So what happens here? Accumulation, manipulation, distribution. We took sell side liquidity, manipulation, 15-minute fair value gap, 4 hour fair value gap. What else do we have here? SMT, right? What else do we have here? 4-minute inversion fair value gap. What happened? What else do we have here? 13 EMA breakout, EMA alignment. We have an order block created, 4 hour candle wick. This is a breakdown of the trade. Okay, you might not understand everything. Where the next video is going to be my trading model, the AP model, what we trade here in GNS is going to be a complete breakdown and 100 examples. Okay. But what's the last finishing touch here? A macro. You can't see the time here, but this is 8 o'clock. I took the trade right here. So it's like 804, 808 when I took the trade. Look how I distributed it. Okay. Um, is that coincidence? I don't know. If it happens a lot of times, then is it coincidence? Up to you to make the decision. So This just ended up being in a macro. This was a triple A setup: 4-hour fair value gap, 15-minute fair value gap, 4-hour inversion, 13 EMA breakout, EMA alignment, sell side liquidity, SMT, AMD, macro. Okay, you should know what the hell I'm talking about here. Okay, we hit a 4-hour inversion fair value gap. We hit a 15-minute fair value gap. We did a 4-minute inversion fair value gap. 13 EMA. We'll talk about that. 13 EMA retirement model breakout. We'll talk about that. I did have the EMA breakout video before this, but I'm going to talk about the retirement model and all that. There's EMA alignment. Okay, fine. But we have a video on sell side liquidity. What did it do? Take sell side liquidity. We have this video right here on SMT. What happened here? SMT. We have a video on AMD. This video. What happened? AMD. They also had a macro. What do we have here? A macro. Like, we'll talk about the 4-hour candle in the next video, but this is all in one right here, and this is why I won. I guess it could easily lose, but we take something like this all of the time. Okay, we want accumulation, manipulation, distribution. Boom. We want it to happen at a macro. Let's see if I can find another macro here. More accumulation, manipulation, distribution. Right? Accumulation, manipulation, distribution. Excuse me. Sometimes I don't realize it happened at a macro. Okay, look at this. Accumulation, manipulation, boom, distribution, right? Hey. Okay, so accumulation, manipulation, distribution. We also have SMT up here. This high was taken over here on NASDAQ. So that means that on ES, it wasn't taken. SMT, that's a clue. What else do we have? Buy side liquidity taken. Look at these highs. All these highs taken. Boom. And then a macro. What time did it happen at? Shh. Sorry, my dog. Hope you guys don't hear. What happens here? At the end of the 8 o'clock to beginning of the 9 o'clock. We took this right here. So this happened like right at like 9:50. We took that. Okay, that's a macro. This one is a AAA A+ setup. Accumulation, manipulation, distribution. We hit a 4-hour fair value gap. We tapped this 15-minute fair value gap. 4-hour candle wick. We see the wick was created here. Boom. EMA alignment. We have a 13 EMA breakout with the EMAs above. Beautiful. 5-minute inversion. I like it with the 13 EMA breakout. Add a macro. SMT. This is how we're building our story. And this is why our win rate is about 80 to 90%, really. So all of my trades have something similar to this. Okay. Here's the thing. Another macro. We took the sells at the macro at like 9 o'clock, right on the dot, and it goes to 9:10, right? So here's the thing, okay? Everything that we taught here is not mandatory. Not every trade for me and for us has to have a market maker model. Not every trade and not every trade that we have here at GNS Academy has to have SMT. It doesn't have to have a power of 3. It doesn't have to have a macro. But when I'm talking on an Instagram video, on a YouTube video that, oh man, like, okay, it was a 4-hour, 15-minute, 5-minute inversion. Okay. And then I had SMT. Like, these are words that we use every day, or we use these words a lot. So you need to know them, or else you're going to be like, well, what's SMT? Well, I have a video for you here. I'll explain to you, of course, but that's why I have a video for you, so that you could understand what we're talking about. Oh man, I went for sales and it was a market maker model. I went for sales, it was a market maker sell model. Like, you should kind of know what I'm talking about. Okay. I went for buys and it had a power of 3. It had accumulation, manipulation, distribution. I went for buys. So what does that mean? It accumulated, manipulated down, and it went up, and I went for buys. Accumulation. I don't have to say, like, be technical. I could just say, I was talking to Mondo, Mondo, like, bro, it was such a good trade, bro. I went for sales and it had power of 3. It was so nice. Okay. Or I went for sales that had SMT. Like, bro, it was so good. You should know what the SMT means. I went for sales. It started a market maker sell model. You should know what I mean. And I took it at a macro. Oh my God. Like, that sounds like a great setup, bro. Okay. Watch this video a couple of times. On the Discord, there's going to be correlated videos. There's going to be a video or two for every topic mentioned in this video. I'm putting in time to make this video. No one's forcing me to do it, okay? so I'm not complaining. But I'm also putting in the time to scavenge through YouTube videos to make sure that I find the right ones so that they make sense with this video that I made. So watch them. I'm doing you the favor of looking through and fucking watching these videos so that what we talked about here could make sense, and also like someone else, you can get another perspective. Okay, so watch them. uh if you're not in the Discord and you're just tuning in, then join the Discord and or leave a comment and we can put you in the Discord and you could watch the videos that are correlated with this. Okay, congratulations, watch this video a couple of times. Okay, go for it and look up on YouTube videos. Look up SMT ICT. Look up market maker model ICT. Look up those stuff. Do some research. But that is the end of this video. Give yourself a pat on the back. Next is going to be the entry model. Okay, you made it very far. We're going to put everything that we learned together in the previous lessons. Okay, we're going to utilize everything that I've been yapping about and talking about to take trades. Okay, we're going to build a story. By now, you should be able to know how to read the market. At least you should know the words. Okay. The example that I gave my other student Raul, learning doji candlesticks, engulfing candlesticks, learning what fair value gaps look like, learning what ICT looks like, liquidity looks like, learning what the EMAs do, learning about SMT, learning about market maker model, learning about PO3, and learning about macro. These are terms and words. That's like knowing how to write words and how to read words. That's like knowing how to write a sentence and how to, you know, write a paragraph. Okay. Now we need to write a story. This is literally English class, but with Japanese candlesticks. Okay. You're not learning English. You're not learning Spanish. You're learning Japanese candlesticks. Now we're going to start making a story. What did we learn in English class when we were in middle school? Introduction, rising action, climax, falling action, resolution. Okay, and we're probably giving you the PTSD trauma from English class, but that's how we're gonna do here. What's the introduction? Top down analysis. Introduction: 4 hour, 15 minute, 4 hour fair value gap, 15 minute entry model, rise, fall in action, and then or entry model, and then we're in the trade, and then resolution will be that we win. But how do we get there? Like, how do we build a story? 4 hour fair value gap, 15 minute fair value gap, 5 minute inversion, 13 EMA breakout, EMA alignment, SMT, market maker model, power of three, macro, and then resolution. The end of the story would be that we win, okay, or we lose. So now we have to put everything we learned together. Okay, I could teach you all these stuff and all the words, but you won't know how to put it together and utilize it. So we finally made it to the home run. This next video is going to be on the entry model. See you in the next video.